FORA.tv. The world is thinking.
I think you're going to see, and I'm going to close with this, a third major period in economic history. The pattern is that the private sector innovates, comes up with new financial or other forms that are very valuable. If they weren't valuable, they'd die of their own weight. But because they are innovative, there are no rules to confine them. So they do a lot of good and they do some damage. And then the public sector has to come along, hopefully without too long a lag, and set rules so that you can maximize the benefit and minimize the harm. The first of these is when you get big industrial enterprises formed in the late 19th century. Without the trusts, we could not have become wealthy. Ma and Pa couldn't have built the kind of country we've had, but they needed to be regulated. So first come the creation of the large industrial enterprises in the late 19th century, then come Theodore Roosevelt and Woodrow Wilson to set rules, antitrust acts, Federal Trade Act, to confine them. Then you get a stock market, because you need a stock market when you've got the big industrial enterprises. No one individual or family can finance them. So you then have a stock market. The stock market obviously produces a lot of good, but it has abuses. So FDR comes along, and the 30s are a period of trying to preserve the worth of the stock market while confining the abuses. The current phenomenon is something called securitization. 30 years ago, if I was a banker giving out mortgages, I would give you the mortgage and you would repay me. Today, very few mortgages are in that situation. In most cases, the person lends you the money and then packages the right to be repaid and sells it. That lessens their concern with whether or not you can repay. And securitization has gotten out of hand. Securitization has a lot of advantages. It allows us to recycle the money more quickly, but it's severely weakened the constraint on bad loans. You know, we've had a flip in this society. 20 years ago, if you were conservative, you bought debt. If you were ready to gamble, you bought equity. Recently, that's been flipped. Debt has been much more risky and much more volatile than equity because so many bad loans were made because they were being securitized. We will be next year trying very hard, and I think we will succeed, to find ways to put some restraints on securitization. Things like credit default swaps. Credit default swaps are issued now without regulation by, now banks are regulated, but we have all these entities that aren't regulated. We regulated banks because, well, they used depositor funds, they got insurance, etc. Now we have all these other entities that are not regulated that are engaging in extremely risky business. And the reason that the Federal Reserve and the Secretary of Treasury have intervened in so many cases is not to save the entity. The shareholders generally get wiped out. But because these entities, these unregulated entities, have become so indebted to so many people and can't pay it back, that their failure would have enormous reverberations throughout the society. Paulson says it's the doctrine of too interconnected to fail. And so what we need to do is to prevent people in the future from getting excessively indebted beyond what they can pay.